What if everything you thought you knew about investing was wrong? Imagine spending your entire life following stock market trends, relying on financial news, and chasing every hot tip, only to find yourself barely breaking even, or worse, losing money. That's where The Intelligent Investor by Benjamin Graham comes in. This book has completely changed the way millions of people think about investing, focusing on minimizing risk and building long-term wealth. Today, we're going to dive deep into the principles laid out by Graham in this timeless classic. If you're ready to rethink your approach to investing and start making sound long-term financial decisions, then you're in the right place. Let's begin with Benjamin Graham himself. Born in 1894, Graham is often considered the father of value investing. His approach to investing is built on rigorous analysis, a focus on long-term gains, and above all, minimizing risk. He was not only a successful investor, but also a teacher, and his philosophy has inspired countless others, including Warren Buffett. In fact, Buffett has called The Intelligent Investor by far the best book on investing ever written. So what makes this book stand out, and how can its principles help you become a better investor? The cornerstone of The Intelligent Investor is value investing. Value investing is the strategy of finding stocks that are trading below their intrinsic value. But what is intrinsic value? In simple terms, it's the actual worth of a company, based on its earnings, dividends, assets, and long-term growth potential. It's what a company is truly worth, regardless of what the market currently thinks it's worth. As a value investor, your goal is to buy stocks when they are undervalued and hold them until the market recognizes their true worth. This approach contrasts sharply with speculative investing, where people buy stocks hoping to sell them at a higher price in the short term, without really understanding the underlying value of the company. To better understand this concept, let's think of intrinsic value as the foundation of a house. You wouldn't buy a house just because its price seems to be going up in the short term. Instead, you'd look at the structure, the neighborhood, the quality of the materials, and the long-term potential of the property to appreciate in value. This is essentially what value investors do when analyzing stocks. They look beyond the market's ups and downs and focus on the core fundamentals of the business. A stock's price might fluctuate wildly in the short term, but its intrinsic value remains relatively stable if the company's fundamentals are strong. Now, let's introduce one of Graham's most important concepts, the margin of safety. The margin of safety is the difference between a stock's intrinsic value and its market price. Think of it as your buffer against risk. The larger the margin of safety, the less risk you're taking on when you invest. Let's say you believe a stock's intrinsic value is $100 per share, but it's currently trading at $60. That $40 difference is your margin of safety. This cushion protects you from potential mistakes in your analysis, or from unforeseen market events that could drive the stock price lower. Why is the margin of safety so important? Because no one can predict the future with certainty. Even the most thorough analysis can't account for every possible outcome. By insisting on a margin of safety, you're protecting yourself from downside risk. In a way, you're admitting that you're not infallible, and you're building in a buffer for when things don't go as planned. This is one of the key principles that separates intelligent investors from speculators. Speculators often buy stocks with little regard for their true value, hoping to sell at a higher price in the short term. But intelligent investors buy with a margin of safety, ensuring that even if the market turns against them, they won't lose too much. To illustrate this, let's imagine you're considering two stocks. The first is a tech startup with a lot of hype, but little in the way of profits. Its stock price has been rising quickly, but you can't be sure whether the company will be profitable in the long term. The second stock is a well-established consumer goods company with solid earnings, a strong brand, and a stable dividend. Its stock price has been beaten down due to a temporary dip in the market, but you've calculated that its intrinsic value is much higher than its current market price. As a value investor, you'd choose the second stock. Why? Because it offers a margin of safety. Even if the market continues to fluctuate in the short term, you know the company's fundamentals are strong, and its intrinsic value will eventually be recognized by the market. This leads us to one of the most famous metaphors in The Intelligent Investor. Mr. Market. Imagine that Mr. Market is your business partner in a company, and every day he offers to either buy your shares or sell you his. The catch is that Mr. Market is highly emotional and unpredictable. Some days he's overly optimistic and offers to buy your shares at an inflated price. Other days, he's overly pessimistic and offers to sell you his shares at a deep discount. The key lesson here is that you shouldn't let Mr. Market's mood swings influence your decisions. Instead, you should view the market's fluctuations as opportunities. When Mr. Market is feeling pessimistic and offering shares at a low price, that's your opportunity to buy. When he's feeling overly optimistic and offering to buy your shares at a high price, that's your signal to sell. What Graham is teaching us through Mr. Market is the importance of emotional discipline in investing. The stock market is full of noise, speculation, and emotion. Many people make the mistake of letting their emotions drive their investment decisions. They buy when prices are high because they're afraid of missing out, and they sell when prices are low because they panic. But the intelligent investor remains calm and detached, making decisions based on facts and analysis, not emotions. Let's now take a moment to explore one of the most fundamental distinctions Graham makes in the book: the difference between investment and speculation. Investing, as defined by Graham, is the process of thoroughly analyzing a company's financial health, understanding its business model, and determining its long-term prospects. You invest with the expectation that the company will grow and generate returns over time. Speculation, on the other hand, is more like gambling. Speculators buy stocks with the hope that their prices will rise quickly, often without understanding the underlying business or its true value. Speculators are driven by short-term market movements and trends, whereas investors focus on the long-term potential of a company. To put this into perspective, let's say you're considering buying shares in a company. As a speculator, you might hear that the company is about to launch a new product that could boost its stock price, so you buy in, hoping to make a quick profit. You're not particularly concerned with the company's long-term prospects or whether it's financially stable. As an investor, however, you'd take the time to analyze the company's earnings, its competitive position in the market, and its growth potential. You'd only buy shares if you believed the company had a strong future and was trading below its intrinsic value. This brings us back to the concept of the margin of safety. Speculators often buy stocks with little regard for their intrinsic value, which means they have no margin of safety. If the market turns against them, they can lose a lot of money very quickly. Investors, on the other hand, insist on a margin of safety, which protects them from downside risk. By buying stocks at a discount to their intrinsic value, investors ensure that even if the market fluctuates in the short term, they won't lose too much. Another key theme in The Intelligent Investor is the importance of long-term thinking. Successful investing isn't about making quick profits. It's about building long-term wealth. Graham encourages investors to think like business owners. When you buy a stock, you're not just buying a piece of paper with a price attached to it. You're buying a share in a business. And just like you wouldn't expect a business you own to double in value overnight, you shouldn't expect your stocks to do so either. Instead, you should focus on the long-term growth potential of the companies you invest in. Let's take a step back and talk about risk. One of the biggest mistakes many investors make is confusing risk with volatility. Volatility refers to the day-to-day fluctuations in a stock's price, but it doesn't necessarily indicate that a stock is risky. Real risk, according to Graham, comes from the possibility of losing your principal, your initial investment. Volatility is something you can often ride out if you have a long-term mindset. The stock market will always experience ups and downs, but if you've invested in a solid company with a strong business model, its price will eventually reflect its true value. This is where diversification comes into play. Diversification is one of the most important tools for managing risk. By spreading your investments across different companies, industries, and asset classes, you reduce your exposure to any single risk. For example, if you invest all your money in a single tech company and that company fails, you lose everything. But if you diversify across multiple sectors, tech, healthcare, consumer goods, real estate, you're protecting yourself from the risk of any one investment dragging down your entire portfolio. So how do you apply these principles in your own investment strategy? Graham breaks down investors into two broad categories: defensive investors and enterprising investors. Defensive investors, also known as passive investors, focus on preserving capital and earning steady returns. They prefer low-risk investments like blue-chip stocks, bonds, or index funds. The goal for defensive investors is to minimize risk and avoid big losses, even if that means giving up the chance for huge returns. Enterprising investors, on the other hand, are willing to take on more risk in exchange for potentially higher rewards. They're more active in managing their portfolios, researching individual stocks, and looking for undervalued opportunities. But Graham warns that being an enterprising investor requires time, discipline, and a deep understanding of financial analysis. It's not for everyone. If you're not willing to put in the work, you're better off following a defensive strategy. In summary, the first step toward becoming an intelligent investor is understanding the core principles of value investing: the margin of safety, emotional discipline, and the difference between investment and speculation. By applying these principles, you can build a portfolio that minimizes risk and maximizes your potential for long-term wealth. In the next part, we'll dive deeper into the specific strategies you can use as a defensive or enterprising investor and how to apply them in today's market. As we dive deeper into the intelligent investor, it's important to understand the key differences between defensive and enterprising investors, as this distinction will guide the strategies you adopt. Defensive investors, as mentioned, are focused on preserving capital and avoiding significant losses. They are not chasing after the highest returns, but are content with steady, reliable growth. Their strategy relies on patience, diversification, and choosing investments that offer long-term stability. Enterprising investors, on the other hand, are willing to put in the time and effort to find investments that may be overlooked by the broader market. They engage in active research, seeking out undervalued companies that might not be on everyone's radar. While the potential for higher returns exists, so does the greater potential for risk. For the enterprising investor, the market offers opportunities that require diligence and constant monitoring. To illustrate these two types of investors, let's imagine two friends, Alice and John. Alice is a defensive investor. She has a full-time job and doesn't want to spend too much time managing her portfolio. She invests in a broad range of well-established companies, blue-chip stocks and bonds, and she also holds some index funds that track the overall performance of the stock market. Alice knows that these investments won't make her rich overnight, but she's content with the steady, moderate returns she expects to see over the next few decades. She's not worried about short-term market fluctuations because she knows her investments are diversified and chosen for their long-term potential. John, on the other hand, is an enterprising investor. He spends hours each week researching individual stocks, reading financial statements, and following market news. John is always on the lookout for companies that are undervalued or misunderstood by the market. He's willing to invest in smaller, less-known companies with the potential for significant growth. While this strategy could yield higher returns, John knows that it also carries more risk. He has to constantly monitor his portfolio and adjust his strategy based on new information. The first lesson Graham imparts to both types of investors is the importance of emotional discipline. Whether you're a defensive or enterprising investor, the ability to remain calm during market volatility is crucial. The market will go up and down, often unpredictably. But the intelligent investor knows that these short-term movements are irrelevant to long-term success. Emotional investors are prone to panic selling during market downturns and buying during bubbles, leading to poor outcomes. Graham teaches that the intelligent investor must remain rational, avoiding the temptations of fear and greed that often drive market behavior. This brings us to one of the most famous concepts in the intelligent investor: Mr. Market. Mr. Market is a metaphor for the stock market's often irrational behavior. Each day, Mr. Market offers to buy or sell shares at different prices based on his mood, which swings from euphoric optimism to deep pessimism. Some days, Mr. Market will offer to buy your shares at inflated prices because he's feeling optimistic about the future. On other days, he will offer to sell his shares at rock-bottom prices because he's feeling pessimistic and anxious. Graham's advice is simple. Don't be swayed by Mr. Market's emotional swings. Instead, use Mr. Market to your advantage. When he's feeling overly optimistic and offering to buy your shares at inflated prices, that's your signal to sell. When he's feeling overly pessimistic and offering shares at a discount, that's your opportunity to buy. The key takeaway here is that the market's mood swings are not reflective of a company's intrinsic value. Intelligent investors should remain focused on the long-term fundamentals of the companies they invest in, and not get caught up in the market's short-term emotional fluctuations. For example, during the 2008 financial crisis, the market was gripped by fear. Stock prices plummeted as investors panicked and sold off their shares. But intelligent investors saw this as an opportunity. They recognized that while the market was in turmoil, the fundamentals of many companies remained strong. Those who remained calm and bought stocks at discounted prices during the crisis ended up reaping significant rewards as the market recovered. Next, let's explore another crucial concept in Graham's philosophy: the margin of safety. The margin of safety is the difference between a stock's intrinsic value and its market price. It's essentially your buffer against risk. The larger the margin of safety, the less risk you take on as an investor. For example, if you believe a company's intrinsic value is $100 per share, but the stock is currently trading at $70, you have a margin of safety of $30. This means you're protected from some of the downside risk if the market turns against you, or if your analysis was slightly off. But how do you determine a company's intrinsic value? Graham advocates for thorough fundamental analysis, which involves examining a company's financial health, including its earnings, dividends, assets, and liabilities. By understanding these key financial indicators, you can make an informed judgment about whether a company's stock is undervalued or overvalued. Let's break down a few of the key metrics that Graham suggests investors look at when determining intrinsic value. 1. Price-to-earnings ratio, PE ratio. This ratio compares a company's stock price to its earnings per share. A lower PE ratio may indicate that a stock is undervalued, while a higher PE ratio may suggest that a stock is overvalued. However, Graham warns against relying too heavily on the PE ratio alone. It's just one piece of the puzzle. 2. Earnings per share, EPS. This metric shows how much profit a company generates per share of stock. A growing EPS indicates that a company is increasing its profitability, which is a good sign for long-term investors. 3. Dividend yield. This measures how much a company pays out in dividends relative to its stock price. A high dividend yield can be a sign that a stock is undervalued, but it's important to assess whether the company can sustain its dividend payments over the long term. 4. Debt-to-equity ratio. This ratio measures a company's financial leverage by comparing its total debt to its shareholders' equity. A high debt-to-equity ratio may indicate that a company is taking on too much debt, which can be risky during economic downturns. By analyzing these and other financial metrics, you can begin to form a picture of a company's intrinsic value. The key is to be thorough and avoid making decisions based on a single metric. Graham emphasizes that successful investing is about seeing the big picture and understanding the long-term potential of a company. Once you've determined a company's intrinsic value, the next step is to apply Graham's concept of the margin of safety. The margin of safety is your protection against errors in judgment, unexpected market events, and the inherent uncertainty of investing. By buying stocks with a large margin of safety, you minimize your risk and maximize your potential for long-term gains. One of the biggest mistakes that investors make is failing to demand a margin of safety. In bull markets, when stock prices are rising, it's easy to get swept up in the excitement and start buying stocks without paying attention to their intrinsic value. But this is a recipe for disaster. When the market eventually corrects itself, overvalued stocks will drop in price, and investors who bought without a margin of safety will be left holding the bag. Graham warns that intelligent investors must always insist on a margin of safety, no matter how optimistic the market seems. Now, let's talk about diversification, another key principle in Graham's investment philosophy. Diversification is the practice of spreading your investments across different companies, industries, and asset classes to reduce risk. The idea is simple. If one of your investments underperforms, the others will help cushion the blow. Diversification protects you from putting all your eggs in one basket. For example, let's say you invest all your money in a single tech stock. If that company performs well, you'll see big gains. But if the company faces unexpected challenges, like new competition, regulatory issues, or a downturn in the tech sector, you could lose a significant portion of your investment. Now imagine that instead of putting all your money in that one tech stock, you also invest in healthcare, energy, and consumer goods companies. Even if the tech stock underperforms, the rest of your portfolio can help offset the losses. Graham teaches that diversification is one of the most effective ways to manage risk. It doesn't eliminate risk entirely, nothing does. But it significantly reduces the impact of any single investment going wrong. For defensive investors, diversification is especially important because their primary goal is to preserve capital and avoid major losses. However, diversification doesn't mean buying as many stocks as possible. Graham emphasizes that intelligent investors should only invest in companies that they understand and believe in. Blindly buying stocks in the name of diversification can lead to a portfolio filled with mediocre investments. Instead, focus on quality over quantity. Build a diversified portfolio of solid, well-researched investments that you're confident in, rather than spreading yourself too thin. At this point, you might be wondering, how do I find the right balance between diversification and focus? How many stocks should I own? While there's no one-size-fits-all answer, Graham suggests that defensive investors should aim for a portfolio of 10 to 30 stocks. This range provides enough diversification to manage risk while still allowing you to stay focused on the quality of your investments. Enterprising investors may choose to hold fewer stocks if they're confident in their ability to pick winners. However, this approach requires a deep understanding of each company and a willingness to closely monitor your investments. Remember, the more concentrated your portfolio, the more risk you're taking on. If one of your investments underperforms, it will have a larger impact on your overall returns. In addition to diversifying across different companies and industries, Graham also encourages investors to diversify across asset classes. This means holding a mix of stocks, bonds, and cash. Bonds in particular play an important role in a diversified portfolio because they provide stability and income. While stocks offer the potential for higher returns, they also come with greater volatility. Bonds, on the other hand, provide a steady stream of income and tend to be less volatile than stocks. By holding both stocks and bonds, you can balance risk and reward, ensuring that your portfolio remains resilient during market downturns. Now that we've covered the concepts of defensive versus enterprising investors, emotional discipline, the margin of safety, and diversification, it's time to dive deeper into specific strategies that intelligent investors can use. Whether you're a defensive or enterprising investor, the key to success is sticking to a well-thought-out plan and remaining disciplined in your approach. Let's begin with the defensive investor's approach. The defensive investor, as we know, aims to preserve capital and minimize risk. For this type of investor, simplicity is key. You don't want to spend hours analyzing stocks or constantly monitoring the market. Instead, you want a portfolio that is easy to manage and will provide steady, reliable returns over time. One of the most effective strategies for the defensive investor is to focus on index funds. An index fund is a type of mutual fund or exchange-traded fund, ETF, that tracks a specific index, such as the S&P 500. When you invest in an index fund, you're essentially buying a small piece of every company in that index. This provides instant diversification, as your investment is spread across many different companies and sectors. The beauty of index funds is that they require very little maintenance. You don't need to worry about picking individual stocks or timing the market. As long as the economy grows over the long term, the value of your index fund will grow along with it. This makes index funds an ideal choice for defensive investors who want to build wealth steadily without taking on too much risk. In fact, Warren Buffett himself has recommended that most people invest in index funds. In his 2013 letter to shareholders, Buffett wrote that the best strategy for the average investor is to put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. Buffett's reasoning is simple. Over time, the stock market tends to go up. By investing in a low-cost index fund, you're betting on the long-term growth of the economy without the need for constant oversight. Another key strategy for defensive investors is to focus on blue-chip stocks. Blue-chip stocks are shares of large, well-established companies with a long track record of stability and profitability. These companies typically have strong balance sheets, reliable cash flow, and a history of paying dividends. Examples of blue-chip stocks include companies like Johnson & Johnson, Coca-Cola, and Microsoft. Blue-chip stocks may not offer the explosive growth potential of smaller high-risk companies, but they do provide a level of stability that is attractive to defensive investors. Because these companies are leaders in their respective industries, they are more likely to weather economic downturns and continue to generate profits over the long term. Additionally, many blue-chip stocks pay regular dividends, which can provide a steady income stream for investors. Speaking of dividends, one of the most important concepts for defensive investors is dividend investing. Dividends are payments that companies make to their shareholders, usually on a quarterly basis. Dividend-paying stocks can be a great addition to a defensive portfolio because they provide both capital appreciation, the stock price going up over time, and income, the dividend payments. When you invest in dividend-paying stocks, you're essentially getting paid to wait. Even if the stock price doesn't rise immediately, you're still earning a return in the form of dividends. This can be especially valuable during periods of market volatility, when stock prices may be fluctuating, but dividend payments remain steady. Over time, the compounding effect of reinvesting dividends can significantly boost your overall returns. For example, let's say you invest $10,000 in a stock that pays a 3% annual dividend. Each year you receive $300 in dividend payments, which you reinvest in additional shares of the stock. As your number of shares grows, so does the amount of dividends you receive. Over time, this compounding effect can lead to significant wealth accumulation. However, not all dividend-paying stocks are created equal. As a defensive investor, you want to focus on companies with a strong history of paying and increasing their dividends. Look for companies that have a consistent record of dividend payments, even during economic downturns. This indicates that the company has a solid financial foundation and is committed to returning value to its shareholders. Now, let's turn our attention to bonds, another important asset class for defensive investors. Bonds are essentially loans that you make to a company or government in exchange for regular interest payments. When the bond matures, the issuer pays back the principal amount. Bonds are generally considered less risky than stocks because they provide a fixed income stream and are less volatile. For defensive investors, bonds play a critical role in balancing risk. While stocks offer the potential for higher returns, they also come with greater volatility. Bonds, on the other hand, provide stability and a reliable source of income. By holding both stocks and bonds, you can create a diversified portfolio that balances growth and income while minimizing risk. Graham recommends that defensive investors allocate a portion of their portfolio to bonds, especially during times of market uncertainty. A typical balanced portfolio might consist of 60% stocks and 40% bonds, although the exact allocation will depend on your risk tolerance, financial goals, and time horizon. The goal is to strike a balance between the growth potential of stocks and the stability of bonds, ensuring that your portfolio can weather market downturns without suffering significant losses. Now that we've covered strategies for the defensive investor, let's shift gears and talk about the enterprising investor. Unlike the defensive investor, the enterprising investor is willing to put in the time and effort to actively manage their portfolio in search of higher returns. This involves researching individual stocks, identifying undervalued companies, and taking advantage of market inefficiencies. One of the key strategies for enterprising investors is stock picking. Stock picking involves selecting individual stocks that you believe are undervalued and have the potential for significant price appreciation. This requires a deep understanding of the company's financials, competitive position, and growth prospects. Successful stock picking can lead to substantial gains, but it also comes with more risk than investing in a broad market index. The enterprising investor must be diligent in their research and analysis. This means reading financial statements, studying industry trends, and staying up to date on market news. Graham emphasizes the importance of being a business analyst rather than a market analyst. In other words, you should focus on understanding the underlying business of the companies you invest in, rather than trying to predict short-term market movements. One of the most important tools for stock pickers is fundamental analysis. Fundamental analysis involves evaluating a company's financial health by examining its earnings, revenue, assets, liabilities, and other key metrics. By analyzing these factors, you can determine whether a stock is undervalued or overvalued. For example, one of the most commonly used metrics in fundamental analysis is the price-to-earnings ratio, PE ratio. The PE ratio compares a company's stock price to its earnings per share. A lower PE ratio may indicate that a stock is undervalued, while a higher PE ratio may suggest that a stock is overvalued. However, Graham warns against relying on any single metric in isolation. It's important to look at the bigger picture and consider multiple factors when evaluating a stock. Another important aspect of stock picking is understanding a company's competitive advantage. Competitive advantage refers to the factors that allow a company to outperform its competitors and maintain its market position over the long term. This could be a strong brand, proprietary technology, economies of scale, or a loyal customer base. Companies with a durable competitive advantage are more likely to generate consistent profits and withstand economic challenges. For example, a company like Apple has a significant competitive advantage due to its strong brand, loyal customer base, and ecosystem of products and services. This competitive advantage has allowed Apple to generate strong earnings growth over the years, making it an attractive investment for enterprising investors. Enterprising investors also have the option of exploring special situations. Special situations refer to opportunities that arise due to unique circumstances, such as mergers, acquisitions, bankruptcies, or spin-offs. These situations can create opportunities for enterprising investors to buy stocks at a discount or profit from short-term market inefficiencies. For instance, imagine a company announces that it's being acquired by another firm. The stock price may fluctuate as the market reacts to the news, creating an opportunity for enterprising investors to buy shares at a discount. Similarly, when a company files for bankruptcy, its stock price may plummet, but enterprising investors who believe in the company's ability to restructure and recover may see this as a buying opportunity. However, special situations require a deep understanding of the specific circumstances and a willingness to take on more risk. These opportunities are not for the faint of heart, and they require careful analysis and a clear understanding of the potential outcomes. Finally, enterprising investors must be mindful of market timing. Market timing refers to the practice of trying to predict the best time to buy or sell stocks based on market trends or economic conditions. While it's tempting to try to time the market, Graham cautions against this approach. The stock market is inherently unpredictable, and even experienced investors can't consistently time their trades perfectly. Instead of trying to time the market, enterprising investors should focus on finding undervalued stocks and holding them for the long term. As long as the company's fundamentals are strong and its intrinsic value exceeds its market price, the stock will eventually rise in value, regardless of short-term market fluctuations. That said, There are times when the market offers clear buying opportunities. During market downturns, when fear and uncertainty drive stock prices down, enterprising investors can find bargains. This is where emotional discipline becomes critical. While most investors are fleeing the market in a panic, the intelligent investor sees opportunity and takes advantage of the lower prices to buy quality stocks at a discount. In conclusion, the enterprising investor's strategy is all about active management, thorough research, and a willingness to take calculated risks. While the potential for higher returns is there, so is the potential for greater volatility. The enterprising investor must be prepared to put in the work, constantly monitor their portfolio, and stay informed about market trends and company performance. As we move into the final part of this deep dive into the intelligent investor, it's time to explore some of the overarching principles and big-picture takeaways that can help guide your investment strategy, whether you identify more as a defensive or an enterprising investor. We've already covered the foundational strategies of value investing, the importance of emotional discipline, diversification, and the difference between speculation and investing. Now let's expand on some of the deeper ideas Benjamin Graham introduced that continue to influence how investors think and act. One of the most significant lessons from Graham's work is the power of long-term thinking. Graham repeatedly emphasizes that the intelligent investor focuses on the long-term performance of their investments rather than being influenced by short-term market movements. The stock market will always be subject to daily fluctuations, driven by news, politics, economic reports, or global events. But these short-term movements should not dictate your strategy. Think about it like this. Imagine planting a tree in your backyard. You wouldn't expect it to grow overnight. You water it, make sure it gets enough sunlight, and over time, with patience, it grows into something strong and stable. Investing works in much the same way. The companies you invest in will not always show immediate returns. In fact, they may go through periods of decline or stagnation, but as long as their fundamental business remains strong and you've invested with a margin of safety, their value will eventually reflect the company's true worth over time. The reason many people fail in investing is that they don't give their investments enough time to grow. They panic when prices drop, and they sell too soon, often at a loss. This is why having a long-term mindset is crucial. By focusing on the big picture, you can avoid the temptation to make impulsive decisions based on short-term market noise. Graham teaches that successful investing is not about getting rich quick. It's about growing your wealth steadily and safely over many years. This long-term approach is best illustrated by the idea of compound interest. Albert Einstein is often quoted as saying, "Compound interest is the eighth wonder of the world." In simple terms, compounding means that the returns on your investments generate more returns over time, and these returns keep growing like a snowball rolling down a hill. The longer you leave your investments untouched, the more they compound, and the larger your wealth grows. Let's break this down with an example. Imagine you invest $10,000 in a diversified portfolio with an average annual return of 7%. After 1 year, your investment grows to $10,700. The next year, your return isn't just based on your original $10,000, it's based on $2,700. After 10 years, your investment has grown to $19,171 without you adding any additional money. Over 20 years, your $10,000 has grown to $38,096. And over 30 years, it's worth $76,023. That's the power of compounding. Your money grows exponentially the longer you leave it invested. This is why Graham encourages investors to be patient. The market will go up and down, but over the long term, it tends to move upwards. If you can keep your money invested for decades and allow the power of compounding to work its magic, you can build significant wealth. However, this requires the emotional discipline to stay the course, even during periods of market volatility. In addition to long-term thinking, another critical aspect of Graham's philosophy is understanding risk management. Graham teaches that risk is not synonymous with volatility, as many people mistakenly believe. Volatility refers to the price swings of a stock, But true risk comes from the potential of losing your principal, the money you originally invested. The real danger in investing isn't that a stock's price fluctuates in the short term. It's that you could lose money by investing in a company with poor fundamentals, or by overpaying for a stock that's overvalued. To mitigate risk, Graham advises investors to focus on value investing and to insist on a margin of safety. The margin of safety is your buffer against errors in judgment or unforeseen events that could negatively impact the market or the company you've invested in. By buying stocks that are priced well below their intrinsic value, you're protecting yourself from the possibility of a downturn. Even if the company doesn't perform as well as expected, the margin of safety gives you some protection against losing your principal. For example, let's say you invest in a stock that you believe is worth $100 per share, but it's currently trading at $60. This $40 margin of safety gives you some protection. If the stock's price drops to $50 or even $40, you're still less exposed to risk than if you had purchased the stock closer to its intrinsic value. The key here is that you're not trying to predict short-term market movements. Instead, you're making a calculated bet that the company's fundamentals will eventually lead to its stock price reflecting its true value. One of the biggest traps that inexperienced investors fall into is trying to time the market. They attempt to buy stocks when they believe the price is at its lowest and sell when they think the price is at its peak. However, as Graham points out, trying to time the market is a fool's game. No one can accurately predict what the market will do in the short term. Instead of trying to time the market, the intelligent investor focuses on finding undervalued stocks with a margin of safety and holding them for the long term. This brings us to another important concept, Mr. Market, the metaphorical figure Graham uses to represent the stock market's erratic behavior. Mr. Market is your business partner, who comes to you every day offering to buy your shares or sell you more shares based on his emotional state. Some days, Mr. Market is euphoric, and he offers to buy your shares at a very high price. Other days, he's depressed and offers to sell his shares at a low price. The intelligent investor doesn't let Mr. Market's mood swings affect their investment decisions. Instead, they recognize that Mr. Market's emotional state doesn't reflect the true value of the companies they've invested in. When Mr. Market is feeling overly pessimistic and offering shares at a discount, that's the time to buy. When he's overly optimistic and driving prices up beyond their intrinsic value, that's the time to sell. The point is to take advantage of the market's irrational behavior rather than being influenced by it. Another key lesson from the intelligent investor is the importance of financial education. Graham argues that many people lose money in the stock market because they don't fully understand what they're investing in. They follow the crowd, chase after the latest trends, or make decisions based on emotion rather than analysis. The intelligent investor, on the other hand, takes the time to educate themselves about the companies they invest in, the industries they operate in, and the broader economic forces at play. This doesn't mean you need to become a financial expert, but it does mean that you should understand the basics of investing. You should know how to read a company's financial statements, understand key metrics like earnings per share, and be aware of the risks associated with different types of investments. By educating yourself, you'll be better equipped to make informed decisions and avoid common pitfalls. In addition to financial education, Graham emphasizes the importance of self-discipline. Successful investing requires patience, discipline, and the ability to stay the course even when the market is volatile. It's easy to get caught up in the excitement of a bull market or the fear of a bear market, but the intelligent investor stays focused on their long-term goals. They don't let short-term market movements distract them from their strategy. One practical way to stay disciplined is to automate your investments. By setting up automatic contributions to your investment accounts, whether it's a 401(k), IRA, or brokerage account, you remove the temptation to time the market or make impulsive decisions. Automation also ensures that you're consistently investing over time, regardless of what the market is doing. This strategy, known as dollar cost averaging, can help reduce the impact of market volatility and lower your average cost per share over time. For example, let's say you set up an automatic investment of $500 per month into a diversified index fund. Some months, the stock market will be up, and you'll be buying shares at a higher price. Other months, the market will be down, and you'll be buying shares at a lower price. Over time, this approach averages out the cost of your investments and helps protect you from the risk of investing a large sum of money when the market is at its peak. Lastly, let's talk about the power of giving back. In the final chapters of The Intelligent Investor, Graham emphasizes the importance of using your wealth and knowledge to help others. He believes that part of being an intelligent investor is recognizing the role we play in society and giving back to our communities. This could mean sharing your knowledge with others, helping friends and family become better investors, or donating to causes you care about. Graham argues that wealth isn't just about accumulating money for yourself. It's about using your resources to make a positive impact on the world. This is a principle that has been embraced by many successful investors, including Warren Buffett and Bill Gates, who have pledged to donate the majority of their fortunes to charitable causes. In conclusion, The Intelligent Investor offers timeless wisdom that can help investors build wealth while minimizing risk. By focusing on value investing, maintaining a margin of safety, practicing emotional discipline, and adopting a long-term mindset, you can avoid the common pitfalls that lead many investors astray. Whether you're a defensive or enterprising investor, the principles laid out by Benjamin Graham are as relevant today as they were when the book was first published. As we wrap up, remember that investing is a journey, not a race. Success doesn't come from trying to get rich quick. It comes from making thoughtful, informed decisions, staying disciplined, and allowing time and compounding to work in your favor. So, the next time Mr. Market comes knocking, offering you shares at a discount or urging you to sell in a panic, you'll know how to respond. You'll be an intelligent investor.